Smoothed bonus funds continue to make a strong argument for inclusion in an investor's portfolio, especially for turbulent times. Old Mutual recently declared a total bonus of 11.5% for tax-exempt investors and 10% for private investors in its range of smoothed bonus funds. Sinenhlanhla Nzama, marketing actuary at Old Mutual, joins us from Cape Town to explain how these work. And Sinenhlanhla, I'm going to ask you to take a step right back and begin by explaining for the layperson what a smoothed bonus fund actually is.
Thanks, Brian. I think I'll actually take 2 steps back. As Old Mutual, we have our retail clients who come and buy savings products. Those could be for retirement or education purposes, or it could be just for any savings, normal savings we'll call them. And then we take those funds that they pay to Old Mutual and invest them in what we call a smooth bonus fund. And this fund is then what we're talking about today, that declares these bonuses on an annual basis. So Old Mutual will earn the investment returns from the assets that we invest in, and then we pass on those to our individual clients.
Sinenhlanhla, we just wanted to get to the idea of the smooth bonus fund concept part of the name there, because obviously from what I've been reading, and we'll talk about this a little bit later, it's in many ways like a balanced fund. Just tell us where the bonus comes into it. You obviously have a mandate that you have to reach, and then anything above that, I imagine, is declared a bonus. So just take us through what the mandate is from the perspective of what you promise to deliver to your clients in this fund.
Yes. Actually, a smooth bonus fund is just a balance fund that will invest in a range of assets. Mainly, it will be about 50 to 70% equities, and then also invest in bonds, property, and other assets. So all the returns that we get, could be interest, could be dividends, could be capital gains, are then put together and then smoothened over time, so that we don't have a situation where if equities are doing very well, for example, then we have a high return given to our investors. And then when they're doing very bad, as we've seen in the recent past, then we have negative returns. So we don't have that situation with this smooth bonus. So it smoothens those returns. Whatever we pass on to the individual client, when times are good, it will be slightly lower than what they will get when they invest directly. However, when times are bad, then whatever we'd had back would be given back to the client. So they get a slightly higher returns. And those returns, as I said earlier on, will be passed on to a client in terms of annual bonuses. And that's what we've been declaring this year at about 11.5 for tax-exempt individual clients, and about 10% for normal investments.
So just for the purposes of illustrating this, just take us through what the payouts were during, say, from 2007 through 2008, 2009, and then 2010. You effectively, what you're doing is taking the returns during the good times and saving them for those tough periods. So is this fund very suitable then for people that rely heavily on the income or the returns from the fund to fund their lifestyles?
Yes. What we know is that for individual investors, unlike corporate investors, individual investors will have very low appetites for risk. So the fluctuations or the volatility or uncertainty in the actual returns from the market can actually be very uncomfortable when they see on an annual basis that, for example, the equities are negative or low. Just as an example, if you look at the all-share index, I think in the past 10 years, I'll just look at the past 10 years rather than individual year. So if you look at the all-share index for the past 10 years, it has given an average of about 15.5%. And in there, you have 2008 and 2011 being negative. However, with the smooth bonus, if you look, I'll just look at the smooth bonus specifically for the low-income clients, which is slightly more conservative. In the past 10 years, for the tax-exempt investors, those will be those who invest in the retirement. They've got about 11.3% net of fees in the past 10 years. And that has been smoothed out. We haven't declared any negative bonuses or returns, we may want to call them, to our investors. So coming out of the financial crisis where the returns have been low or even negative, we've declared, I think the minimum that we've declared for our investors is 6% when the times were bad. where we could have, in a normal balanced fund, would have been a negative amount.
What is the mood like in investment circles at Old Mutual right now? You refer to the financial crisis. We've obviously got some further trouble on the horizon when it comes to Europe, and that's hot on the heels, obviously, of the Cyprus furore. Where does your team think we are going from an equity perspective?
I think it's obviously very difficult to predict where the markets will be going. Today we're up, tomorrow we're down. But I think coming from the financial crisis since 2008, which we believe the storm is not necessarily over yet. Especially last year, we saw in the first half of the year where there was a major slowdown in the US and in China. And then the Euro crisis came in. Even though we have the central banks trying to manage the situation internationally, we still had a lot of turbulence and a lot of volatility. And it was very, very difficult to markets. That was on the international front. But then later in the year and early this year, late in the year 2012 and early this year, we've seen that the rand has been weakening. So that's on the local front, and that makes even those international markets much more worthful than the local equities. So for individual investors, that can be quite a challenge, can be quite volatile. And for us at Old Mutual, we try to have these kind of products like the Smooth Bonus Fund, where we say, regardless of what the markets may do tomorrow, we need to ensure that our individual investors' funds are much more diversified and they are protected from these volatile markets, especially the downside risk, while they still enjoy some upside risk when the markets are doing very well. So I think to give you a short answer, we do not know what the markets will be doing tomorrow. However, we know that for our investors who are in the Smooth Bonus Fund, they have some protection in the down risk side.
Sinenhlanhla, I just wanted to bring that round and add to Bronwyn's question then in a different way. While you can't predict what's going to happen in the future, you've got to make some big calls around asset allocation to ensure that you continue to pay those bonuses. Just give us some insight as to what the portfolio looks like at the moment from the point of view of the asset class mix at this point.
Okay. Yes, I think currently we have two types of smooth bonus. We have one for high income earners and one for low income earners, because we believe obviously different investors have different risk appetites. So just to answer that, I think if you look at the high end investors, we have about 56% in equities. And remember I said earlier on, smooth bonus will typically be covering about 50 to 70% or invested in the equities. So you can see we're on the bottom side of that range because of this uncertainty, while we have about 25% in bonds. And that range will usually be about 10 to 30%. So we're slightly more on the bond side. And we're investing about 7.5% in the equities. If you look at for the low income investors, there's not a major difference in bonds and equities. We're still about 22% in bonds and 7.5 equity property. However, equities is much lower there. It's not 56%, it's about 50%. And we have about 10% of that fund in money markets, because we believe that the uncertainty, especially for the low income investors, is quite hard to stomach than the high income earners. And then we have that money market kind of exposure at the moment. And I don't see that changing very much largely going forward in this, at least for the rest of this year.